why do people really love owning real estate? For a lot of people, it is really hard for them to feel the tangible benefit of owning stocks, right? You can see the paper value go up, but it's not very controllable. It doesn't feel real like a property does. And so a lot of people will ignore the stock market or other investments because property feels real. It's tangible. You can move into it. Somebody else can live there, etc. The other reason is they love cash flow. All the time, what I'll see is that people are so focused in on cash flow, when at the end of the day, the goal is to have investments that build wealth, right? If you're 35 years old, you make $1 million, you're in the 37% tax bracket plus state, the goal is not cash flow, right? You already have so much cash flow. All the time I'll see people so focused in on interest, income, etc. It's really tax efficient, right? If you live in California, 37% bracket, you're going to lose about 50% of all of that income to taxes. Yes, it'll be a little different with real estate potentially because of depreciation, but cash flow is a reason people love real estate, right? I have a property, it costs $2,000 a month. I rent it out for $3,000. I get $1,000 a month benefit. That cash flow goes into my pocket and it feels really good. Again, people are so focused on this because they think in retirement they need cash flow, when in reality, they just need cash. So that can be raised from investments. It can be from capital gains, interest, etc. It doesn't truly need to be cash flow from investments, but I get why people view this and think it's really important. The next reason people love it is because of you're basically having somebody else pay down the debt on an asset that's appreciating. So we go to that example, right? They have $3,000 of income, $2,000 of expenses. A lot of that is going to paying down the mortgage and paying down that debt. So even without the asset growing in value, you're building more equity in it. And so you're more invested, right? If you had $400,000 on a mortgage and now it's down to $380,000, you have $20,000 more equity in that property. So that's true value for yourself. Over long periods of time, real estate does tend to go up. So somebody's paying down the debt on an asset that is appreciating. And the last big reason people love real estate is because of the tax benefits. So the first thing that you need to understand is depreciation. Depreciation is how most people can own real estate and pay very little amounts of taxes. What ends up happening is, let's say you buy $1 million property, $200,000 is the land, $800,000 is the value for the home. Why is this important? Because the land can't be depreciated, but the property is. So what happens is they're going to say $800,000 value of the home. We're going to depreciate this straight line over 27 and a half years. So whether you actually do this on your tax return or not, the property is being depreciated. So it's 800,000 divided by 27 and a half. That amount is what gets depreciated per year. So unless your income is higher than depreciation, interest, expense, etc., you are going to have cash flow in a perfect world with very, very little taxes. That's what people love about it, right? Cash flow without taxes is something that doesn't really exist in many areas. And so a lot of times people are like, great, I love this. I have these losses and it gets to go offset my income from my W-2 job or my business. But that's wrong. What real estate is it's considered passive income unless you hit one of two tests or designations. The first one is rep status. That just means you're a real estate professional. If you're a real estate professional, then you can use losses from real estate to go offset other active income. Active income like a business, a W-2 job, etc. The issue is to qualify, you have to spend 750 hours or more per year on real estate and more than any other job, right? So all the time I'll have doctors or private equity guys come to me and say, I'd love to be a real estate professional and go offset my income. The issue is that they work 2,000 to 3,000 hours a year on their main job. They're never going to go beat that in real estate, right? So if you work 2,005 hours in your regular job, you need to work at least 2,006 in real estate to make it active and offset that income. It's not really going to happen. But what could happen is you could have a spouse who's maybe a stay-at-home parent or has part-time job. They could become a real estate professional. That would work. And then if that happens, then you can go use those losses to offset the active income. If not, then these passive losses can go offset other passive income, or they can be pushed forward to the next year and the next year, et cetera, until they all get used. The only other way to qualify is through short-term rentals. And so with short-term rentals, basically there's a bunch of tests. You can go look them up. I've written about them. But the ones that we see people pass where it actually works is they spend 100 hours or more per property per year, and they spend more than anybody else. So if the cleaners end up spending more hours than you lose that active status. All the IRS is trying to look at here is, did you actively participate more than basically anybody everybody else. And so with the short-term rentals, right, if the average stay is under 7 days or less, you stay there for under 14 days a year, and it's 100 hours or more per year per property and more than anybody else, then now you can use those losses to offset other active income. This is the area where I've seen a lot of people use it. The issue is that you have to log this well. They have logs. You want to keep track of your hours. Things that are regular admin type work, like driving to there or like dealing with the renters or some of those things, right? Those don't count. It's really like you going there and cleaning and like doing projects and different things like that. And it is very doable to get there, but you have to do it right. This is a very audited strategy. At the end of the day, right, that's the tax benefits that people love. The last one is that you can do cost segregation studies and bonus depreciate the property. All that really means is they basically look at the property, they look at things inside of it, they basically give it certain years it can be depreciated, and then you can accelerate that and bonus depreciate it in this year. It used to be 100%, then 80, then 60, now we're at 40. It's supposed to scale down to 0, but in Trump's new proposed tax bills, they want to bring this back to 100%. So what this allows people to do is say, hey, I bought a new property, I'm going to depreciate significantly more in 1 year. That's going to give me a really, really, really big loss, and I can use that loss to go offset either passive income or active income. The one thing that you need to know is that you are going to recapture this tax later on at a higher tax rate than capital gains. So it is something you want to plan for. And typically you want to hold this investment for 5 or more years if you're going to actually do the cost segregation and bonus depreciation on the property. This is a really great tool. It's something that we'll see people do in really high income earning years if they can qualify either through rep status or short-term rental loophole. But it's this really good benefit that can help minimize tax. You know, a lot of people hear all this and they say, I really want to own rentals. It sounds really great. And I'll tell you, it can be. There are a lot of people who own quite a bit of rentals and they've become very successful doing it, but they've become very successful because they start with one, they learn, they replicate that knowledge, they do more and more and more, and it ends up becoming kind of a full-time job and they run it actually like a business. The issue is I see a lot of people do the opposite. They only have 1 property or 2 properties, right? Which means a lot of learning, a lot of time to not replicate that knowledge, and 2, they don't really get a whole lot of tax benefits out of it, and it takes up quite a bit of time, and they don't run it like a business. They don't have an emergency fund. They're not properly insured. So they have a bunch of risks where, you know, they could be sued personally for things that happen because they don't have the right insurances or have it in LLC, etc. So you want to make sure if you're owning rentals, you do it correctly. How a lot of people get to their first rental is they turn their first house into a rental. I think this can be good, but I also think this can be bad, and it really depends on the equity. What most people look at is they say low interest rate, I should keep this property. That is a factor, but it isn't the most important factor. So let's say with a property, you live there, it's your primary home, it's worth $500,000, you have a mortgage at 2.5%, and you get $500 a month of cash flow if you were to rent it. $500 a month of cash flow, $6,000 a year, not good, not bad. And because of that low interest rate, you're able to have that positive cash flow. But the factor that we haven't talked about here is the equity in your home. Let's say that you bought that property for $450,000, you put 5% down, it's worth $500 now. Equity wise, you have about $75,000 into it, let's say. So this is not a huge amount. If you were to sell your rental property today, assuming you lived there 2 of the last 5 years, etc., you get a capital gains exclusion of $250,000 if you're single, $500,000 if you're married. So on $75,000, you would save basically, let's say 15% capital gains. Not a whole lot, right? You can recapture that equity pretty quickly, or the tax savings you had. But let's say it's different, right? You bought this property for $500,000, now it's worth $1 million, right? And you have $500,000 of equity. And let's say you're a high income person in California and you pay 20% long-term capital gains, 3.8% net investment tax, and then over 10% state. So if you choose to not sell this property, then you're going to have to later pay capital gains taxes on that $500,000 that you would have avoided. And so if you have, let's say 30% capital gains bracket with everything included, $500,000 would be $150,000 of tax savings. If you're only going to get $10,000 of cash flow a year, it's going to take you 15 years to recoup that $150,000. Sure, you could have some appreciation during the time. Sure, you're going to have some debt pay down, but you're giving up a really, really big benefit. And so most times it ends up, if that's the situation, making sense to sell that property, take that equity, and maybe buy 2 or 3 or 4 for rentals, this is where it starts to become better, right? So when you look at a rental and look at how good is this rental, you really want to look at what's the return based on that equity, right? So if you have $500,000 of equity in that home and you get $6,000 a year, that is a terrible return on $500,000, right? If you move that $500,000 to cash, 4%, no risk, nothing, you get $20,000. Now let's say, hey, you only have $100,000 of equity on that property and you get that $6,000, right? That's 6% return on equity. So that is significantly better. The rentals that are the best are the ones with low equity, because low equity gives you more leverage, and more leverage gets you higher returns. And the reason why rentals are good is because of that risk, right? Because of the leverage that you take. If you put $100,000 down on a $500,000 property, you have 20% equity. If that property grows by 10%, so it grows to 550, it's not that it grew from 500 to 550, it's your 100,000 investment grew $50,000, right? Because that's the equity that you got from it. That is truly one of the biggest benefits when you look at rental real estate. You know, people ask me all the time, like, should I own rentals? Should I not own rentals? And my recommendation is, if you want to own rentals, do it, but don't own one or two. If you're going to own rentals, you want to have a plan to accumulate a bunch of them, replicate that knowledge, continue to run it like a business, and maybe become a real estate professional, and you'll get a ton of really great tax benefits from it. If you're thinking about moving out of your home and you're like, oh, you know, I might as well just turn this into one rental. I don't want to own rentals, but this one would be good. I found that almost nobody enjoys that, because it's a lot to learn. It's a lot of work. It's not a lot of cash flow for just one single property. And it's a lot of headaches. You know, at the end of the day, rentals can be really good for the right people. Rentals can be really bad for the wrong people. But at the end of the day, it's understanding what you want and understanding the benefits, right? So low equity can be really good. The tax benefits can be pretty good, but understand active versus passive. The last thing you want to do is go buy this property, plan on the losses to be used elsewhere when they can't be. Thank you for watching. If you enjoyed this video, please leave a like and go follow my page for more personal finance content. And as always, if you have any thoughts, please leave it in the comments below, and I promise to get back to each individual comment. See you next week.